The crypto market is a highly efficient machine built to transfer capital from the untrained to the prepared. If you enter this environment without a strict plan, you will lose everything. Survival starts with custody. Leaving your assets on a centralized exchange means you do not technically own them. The 2022 bankruptcy of FTX proved that when these platforms fail, user accounts are frozen and entire portfolios vanish. For any capital you are holding long-term, move it offline. A hardware wallet is a physical device that stores your private keys off the internet, removing the risk of exchange hacks or corporate insolvencies. Active trading requires a reliable baseline setup. This includes an established exchange for executing orders and a dedicated charting platform like TradingView to analyze price movements and set automated alerts. Reliable tools only solve for technical execution. The primary barrier to profit is a trader's own reaction to price movement. The market amplifies personal traits like impatience or greed, turning internal tendencies into realized financial losses. Advanced charting and secure wallets provide no advantage unless you deliberately rewire how you process risk and your own emotional responses to the screen. To survive the external mechanics of crypto, you need to understand the broader timeline. Historically, this market moves in a 4-year cycle, driven by an event built into Bitcoin's code known as the halving. This chart maps the historical 4-year Bitcoin halving cycle. Every 4 years, the reward for miners is cut in half, reducing the new supply entering the market. Historically, this supply shock triggers a 12 to 18-month bull market, followed eventually by a drawdown of 70 to 80%. These drawdowns catch amateurs off guard because they ignore the warning signs. Cycle tops typically coincide with uniform euphoria in mainstream media and fear and greed index readings above 90. That is the signal to take profits, not to enter new positions. Timing the cycle is useless if you trade the wrong assets. Stick strictly to high liquidity coins like Bitcoin and Ethereum. High liquidity means there is a massive pool of active buyers and sellers, allowing you to enter and exit positions instantly without suffering slippage. Warning tone: avoid newly launched tokens and meme coins. They lack structural fundamentals and predictable chart behavior. They are frequently controlled by insiders who use social media hype to dump their shares onto retail buyers. Before you place a trade, verify the daily trading volume. A safe baseline is $100 million. Below that threshold, the market is too thin, making technical signals unreliable and the asset easy to manipulate. Mapping the 4-year cycle and restricting your trading to high-volume assets mathematically insulates your portfolio from the traps that wipe out cycle beginners. The structure of your day dictates your success. Start your morning by checking the broader macroeconomic environment. Federal Reserve interest rate decisions, inflation data, and regulatory announcements directly drive the flow of capital into risk assets like crypto. After a quick scan of your charts to identify key levels, step away from the screens. Go live your life and rely on price alerts to notify you when a relevant level is reached. This distance enforces equanimity, the ability to remain emotionally stable regardless of the outcome. You must stay as calm during a winning streak as you are during a deep drawdown. Your feelings cannot dictate your execution. To achieve this, reframe your account balance as abstract units of risk, rather than rent money or life savings. When you view capital merely as units in a system, the emotional weight of a single trade disappears. Losing streaks are guaranteed. When they happen, your trading journal serves as the objective record. By logging your entry, exit, and emotions, you determine if you are suffering from statistical variance or if you are breaking your own rules. Adhering to this routine forces the state of emotional stability required to trade professionally. In the long run, mechanical discipline outlasts raw intelligence. There is a legal reality that most beginners ignore until they face penalties. In the United States, the IRS treats cryptocurrency as property. Every single time you trade or exchange a coin, it is a taxable event. Profits from assets held for less than a year are taxed as short-term capital gains, matching your standard income bracket. Assets held for over a year secure a lower long-term capital gains rate. Real trading consists of tedious tasks like tracking tax liabilities, filling out spreadsheets, and waiting for days for the right setup to emerge. It bears no resemblance to the wealth-building fantasies common on social media. Before you put a single dollar into this market, Open a paper trading account. Practice with fake money for 30 full days to prove that your system works and that you have the discipline to follow it. The digital asset space will continue to provide opportunity. However, life-changing financial progress is reserved for those willing to embrace the boring, rigorous work of mastering their own minds. You see a post about a coin pumping. You download an exchange, throw in some cash, and buy. Then the price drops. Panic sets in. You sell at a 30% loss and walk away feeling foolish. This chart shows the reality of the 2026 market. Massive hedge funds and professional traders dominate the space, using algorithms and structural patterns to extract capital from the chaotic reactions of beginners. While retail traders chase social media hype, institutions operate within a structured mathematical grid. Professional traders focus on high-probability setups rather than trying to guess the exact moment a price will turn. Like a casino, the house doesn't win every single hand. However, by ensuring their wins are mathematically larger than their losses, they maintain a net positive trajectory over hundreds of trades. In an environment explicitly built to take your money, mechanical discipline is your only defense against superior institutional capital. Before entering a trade, you have to choose your battleground. Spot trading is straightforward. You buy the actual asset and hold it, even if the price steps. Futures trading uses leverage to control larger positions, but even a small price move against you can result in total account liquidation. This diagram illustrates a standard bullish trend. When the 50-day moving average crosses above the 200-day moving average, it confirms that the asset has consistent upward momentum over both the short and long term. Instead of buying while the price is surging, you wait for a pullback. This occurs when the price briefly dips back down to touch the moving average before continuing higher. This zone offers a lower risk entry point compared to chasing a vertical price move. These horizontal boundaries represent support and resistance. Support is the price floor where institutional buy orders are concentrated, and resistance is the ceiling where selling pressure is high. These zones are the structural levels where price is most likely to reverse. A confirmed breakout happens when the price closes a candle above the resistance ceiling, alongside a surge in trading volume. Without that volume spike, you are likely looking at a manipulation attempt designed to trap buyers before the price falls back down. Using these structures provides a repeatable framework for entry. You are no longer reacting to every random price jump, but instead waiting for the specific scenarios that offer a statistical advantage. Even with high probability setups, you will encounter losing streaks. Survival depends on the 1 to 2% rule, which limits the total capital you are allowed to lose on any single trade. To calculate this, start with your total account size. If you have $5,000 and risk 1%, your maximum loss for the trade is $50. Next, find your risk per coin by subtracting your stop-loss price from your entry price. If you buy at $100 and set your exit at $90, you are risking $10 per coin. Finally, divide your total allowed loss by the risk per coin. $50 divided by $10 means your position size is exactly 5 coins. Calculate this scenario: a $2,000 account at 2% risk. Your entry is $50 with a $40 stop loss. Your max risk is $40, and your risk per coin is 10. That gives you a position size of 4 coins. When you lead with this calculation, the risk of the trade becomes a fixed number you've already accepted. This prevents the hope-driven hesitation that leads traders to ignore their stop losses and allows you to focus strictly on capital preservation. A beginner who strictly follows these rules may only see their account grow by 10 or 15% over 3 months. This isn't the rapid wealth promised on social media, but it represents the slow, consistent portfolio growth required to stay in the market long-term. The most difficult part of this process is refusing to move your stop loss when a trade turns negative. Traders often tell themselves the price will recover if they just give it more room, turning a manageable 1% loss into a catastrophic failure that wipes out weeks of progress. You must also avoid overtrading, using high leverage without experience, and buying into influencer hype. These are the primary ways retail capital is transferred to institutional players. To maintain discipline, you must keep a trading journal. Recording every entry, exit, and the emotional state you were in during the trade allows you to identify the specific behaviors that lead to errors. Successful trading is the repetitive execution of this mathematical system. While the rest of the market gambles on emotion, you sustain your capital by following the same set of rules, regardless of the hype.